Good morning, Bitcoiners. Hello, and welcome back to your economic calendar. I'm Mauricio, Ledden's co-founder, and as with every Monday, we bring you the news and analysis you need to start the week off right in Bitcoin. Today is Monday, August 30th, and we have a very special show as always. In today's episode, we're going to start by talking about Morgan Stanley Funds, who have increased their exposure to Bitcoin by 33 times since June. We're going to look at some more insights from those filings. Second, there's evidence to suggest that a Bitcoin futures ETF may be launching in Q4. We're going to look at who that issuer is and what other insights we can find from this upcoming launch. And last, we saw that Visa bought a punk last week. So what? We're going to take a look at some of the implications. And certainly not least, we're going to look at our interest rates for September. So stay tuned. It's going to be a great one. So the first thing we wanted to cover in today's video was our interest rates for our savings accounts as of September 1st. So as you can see on your screen, the savings rates for Bitcoin will be holding still at 6.1 APY for your first 2 Bitcoin and 2.25% APY for any balance of Bitcoin beyond 2. Second, our USDC savings accounts are going up to 9% APY for all balances. So we also have no fee trading within the platform and the best rates for your Bitcoin backed loans in case you need some access to liquidity and don't want to sell your Bitcoin. So if you don't have a Ledden account, check us out at ledden.io today and start earning the best interest rates in the industry for your favorite assets. Starting as we usually do with Bitcoin, we see that last week Bitcoin closed its first weekly loss after 5 consecutive weeks of gains. The drop was of 1% on the dot, and the close was at $48,808 for the week. Now, the drop, if we consider the ascent on the previous 5 weeks, the drop is in fact quite moderate, because as we can see here, Bitcoin's been up basically 55% in the 5 weeks prior to last week's performance. So a 1% drop after rising 55%, it's not all that bad. From a technical standpoint, we see that the close was actually relatively positive, given that because it closed above 48,800, it tends to be, from a technical standpoint, quite positive. As we see here, there's quite a well-defined resistance range within $48,800 and $50,800, around that range. But there's not that much resistance once you clear that level. So it would not be surprising to see Bitcoin consolidate around these levels for just a little bit longer. Some of the interesting news that came out last week, we saw one of the most important headlines was that Microstrategy bought even more Bitcoin. On Tuesday, Michael Saylor announced that his company had purchased an additional 3,907 Bitcoins for roughly $177 million in cash. The average purchase price there was $45,294 per Bitcoin. And as of last week, the company holds essentially 109,000 Bitcoins, equivalent to roughly $2.9 billion. Their average purchase price for their entire stack is $26,769. which relative to current prices, it's pretty much a 100% appreciation for Mr. Saylor. So very interesting. While not as large as some of the earlier purchases, it is a significant deployment of cash and a signal to other institutions that the current price levels are not too high. So interesting news there out of Microstrategy. We, as we mentioned in the headlines, very interesting news that came out last week was that Morgan Stanley Funds have picked up over 1 million shares in the Grayscale Bitcoin Trust as institutional adoption for crypto mounts. This is a headline from Business Insider. And the interesting thing here, as we mentioned, we'll break down the positions, but also go into the implications for a second. So Wednesday, news broke that Morgan Stanley now holds 922,000 shares of the Grayscale Bitcoin Trust, which is roughly $36 million in positioning. In the total positions, and that's across more than 30 portfolios. Now, the interesting thing here is that back in June, Morgan Stanley disclosed that it held just 28,300 shares of GBTC roughly through their opportunity fund, which means that basically since June, they have increased their exposure to Bitcoin by 33 times. So they grew the position 33 times in 3 months. So pretty meaningful, and it speaks to the appetite around the institutional sort of market and circles. In other big bank and Bitcoin news, JP Morgan disclosed owning 62,000 roughly 62,600 shares in Coinbase as of June 30th. At current prices, that's a position of around $16 million. Well, that's a $16 million investment in Coinbase by JP Morgan. And lastly, billionaire Bill Miller's fund also reported holding 1.5 million shares of GBTC, worth about $60 million. Yeah. Now, the trend here is quite clear. Billionaires and banks do not want to be left behind. Another interesting note came courtesy of Bloomberg analyst Eric Balchunas, who said on Wednesday that there's pretty solid evidence for an October or perhaps November launch in reference to a Bitcoin futures ETF. And that is the headline that you have from Yahoo Finance in the back of your screen. Now, as we've mentioned in the past, the SEC is looking more favorably at futures-based ETF applications. And that brings us to this headline. The issuer that submitted the first application for a futures-based ETF and therefore has the highest chance of getting its first approval is Valkyr. As the title in the back of your screen reflects, this is a team or a group that perhaps is not as well known in the industry as others, but it is run by a team with a lot of experience. We want to wish Leah and Steve at Valkyr their best of luck, and we hope to see their product listed soon. So Valkyr is the issuer that is first in its application to launch a Bitcoin futures ETF. So very exciting to see this coming down the pipe, and also very exciting to see this going to a great team, hopefully. Now, there are some serious and important implications here for this Bitcoin ETF launch. One of them is what's going to happen to other potential ETF applicants. And for that, I wanted to pull up this chart. Just 1 second. There it is. And what you have in the back of your screen is the Grayscale Bitcoin Trust premium or discount to net asset value. So where the value of the fund is relative to the market value of the underlying Bitcoin that it holds. So Grayscale has publicly announced its plans to turn the GBTC fund into an ETF. When this happens, the thesis is that the units of the fund should trade at par value to the underlying shares of the fund, or to the underlying Bitcoin that the fund holds. However, having ETF alternatives in the market may delay GBTC units reaching parity with its underlying assets. This means that the original investors that exchanged Bitcoin into units looking to sell them at a premium will now have to wait even longer to get their money back. The alternative is to get out now and crystallize a double-digit loss when they were expecting a profit. As you can see here, the discount to net asset value on this fund is currently basically trading at a 12.06% discount to the assets that it holds. New investors in the fund, like Morgan Stanley, who we just mentioned, and others, are basically buying Bitcoin at a discount through the units of the fund and have a long time horizon to ride that wave of price parity, or ride that wave of appreciation all the way up to price parity. So again, interesting implications here for GBTC, given this other now futures-based ETF in the mix. Lastly, there were some leaked pages out of a Fidelity report on Bitcoin last week, which had interesting charts showing Bitcoin adoption relative to other recent technologies. Here's the chart for reference. Now, as the chart displays, there are some astounding similarities between the adoption curves of Bitcoin addresses, or addresses with a balance, active BTC addresses, and when you're comparing those to, say, broadband internet subscriptions and mobile phone subscriptions. So this is just food for thought, but we can see here that the adoption curve for Bitcoin active addresses, as well as Bitcoin addresses with a non-zero balance, basically have some pretty similar shapes to those of internet and others. We will take a look at what the futures and options markets are saying around Bitcoin in our What's Ahead section later today. Moving over to US equity markets, we see that the S&P 500 zipped to a fresh all-time high last week, finishing Friday's session up 1.56% for the week last week, up closing at 4,511 points. So that's a 1.56% rise for the week. The NASDAQ also reached a fresh all-time high of its own, up 2.26% last week. And the biggest winner of the week for last week's session was actually a usual suspect that we track here quite often, which is the Russell 2000 index. This index tracks the smallest listed companies, or is a great benchmark for the very, very small companies that are publicly traded. So as you can see, the Russell had a great week, but if you zoom out, it's still quite range bound, and it's by no means a sign that it has confirmed a particular direction, either up or down from this current range. So again, still no confirmation from the Russell 2000. But as highlighted in last week's issue, Jerome Powell's speech last Friday had a big impact in the markets. And let's put up that some headlines from that speech behind your screen right now. Mr. Powell, in his statement, basically says that he sees the tapering of the bond purchasing program by the end of the year. He says, however, there's still much ground to cover before rate hikes. And again, by tapering, he means slowing down the purchases of longer dated bonds by elevating the interest rate. He means basically raising the overnight borrowing rate, which are two very different things. So, and we'll get into that in a little bit. So while Fed officials decidedly signaled that the tapering of the bond purchase program should start sometime this year, Powell's comments appeased markets by suggesting that the benchmark overnight interest rate will not be rising anytime soon. Looking at what analysts are predicting, Goldman Sachs is predicting that the Fed will start cutting purchases by $15 billion per meeting, and those $15 billion will be cut in $10 billion cuts to the US bond treasury program and $5 billion cuts to the mortgage-backed securities program. For context, the Fed has 3 meetings left in the year, September, November, and December, which means that they will be looking at, as per Goldman's, they'll be looking to cut back $45 billion of those purchases. And for further context, the Fed is currently purchasing $80 billion a month of treasuries and $40 billion a month of mortgage-backed securities. So again, interesting plans here, but the news certainly did not seem to discomfort the market, as Friday was a very positive day. Now, Powell's statements on Friday also coincided, ironically, with higher than expected inflation data out of the US. Let's put that headline behind your screen. So the personal consumption index reading for July came out at 4.2%, higher than June's 4%. This is 2 times the Fed's inflation target, as you can see highlighted in this article, which has a pretty nice sort of risk dial here, showing where the 10-year average is for the CPI, as well as CPI minus food and energy. As we can see, we're both well above the Fed targets. Additionally, some of the interesting data that we highlighted here in the last issue that was coming out last week was the new home sales data. That data came out and it showed that there were 700,000 new homes sold in July, which was more than the homes sold in June, 676,000. Let's put a headline from this data point here. So again, another interesting point from the data that came out last week around home sales was that new home sale prices, the mean new home sale price was up by 18.4% relative to July last year. 18.4% increase in home prices from year over year since July. That's quite remarkable. To highlight some of this data, here are the new one-family houses sold. Basically, the median price of a new one-family house in the United States, as per the latest report, was $390,000, the median price for one-family homes. There are virtually, the other data that came out of the United States is that there are virtually no new homes in the United States being sold for under $200,000. And that becomes very clear from the graph that you have on your screen right now, which basically sees, in this red area is the homes below $200,000, while in 2002, they made up more than half of the homes sold in the entire United States. they are essentially extinct. There's very little left, but the chances of purchasing a new home under 200K in the US are all but gone. So this data sounds alarming, and based on Powell's comments on Friday, one would expect that bond yields would be rising based on this data. They did not. If we look at the year on the 10-year and the year on the 30-year, if we look at the performance on Friday, down 2.3% yield on the 10-year note. If we look at the yield on the 30-year note, that was down 1.18% for the day on Friday. As we can see, as you just highlighted, the yields on the 10-year and the 30-year came down, 2.23 and 1.18 respectively. The market seems to be agreeing with the Fed's transitory inflation view and pricing low inflation pressures beyond the next 2 years, as evidenced by the yields on the 10-year and 30-year, which are way far out, coming dramatically down on the news. What does this mean? It means that the Fed still wants to let the economy run. It does not want to disturb markets until it is closer to full employment. They will likely start tapering their purchases on the later part of the bond curve, so 10 to 30-year durations, where demand seems to be steep at the time. If they execute their plans as intended, this should lead to a very soft landing of their purchase program tapering. Whether they can raise short-term rates after tapering the purchase program remains to be seen. So lots of moving pieces here, but we will keep you posted, and we'll talk a little bit more in our What's Ahead section. Moving over to gold, we saw that gold had a very positive week, up 2.01% at $1,816 per ounce. Most of the gains, and let's go back to the daily here because we're in the weekly start. So as you can see, most of the gains for the session came on Friday, basically on the back of Powell's comments. Gold rose 1.36% for the day. This was, so if we go back to the weekly, just so you can see, essentially this close was gold's highest weekly close in more than 70 days. As you can see here, basically this close is well above pretty much most closes before this week, so June 7th. So pretty interesting. Again, gold seems to be picking up, and this resistance line seems to have turned into support. So as geopolitical tensions continue and the Fed lets short-term inflation run higher, the real return on US bonds will remain under pressure. As we know, generally this environment is good for gold. So we'll keep you posted as gold continues to perform. Moving over to the FTX DeFi index, we see that the index finished down 3.87% for the week, which was actually worse off than Ethereum's drop of 50 base points. Ethereum closed at $3,225. Pressure on most layer 1 and layer 2 crypto assets could be partially attributed to the rise in popularity of NFTs, as people look to take profits in Bitcoin, Ether, and DeFi tokens to indulge in art. Among the news this week in DeFi, or in the DeFi space, one of the interesting news that came out was the disclosed bug in the Ethereum network, which led to a fork in the chain. Let's find that headline. And here's the headline, courtesy of the block. And again, just to do a brief summary here, there was an upgrade sent to Ethereum nodes to patch a software bug. For a while, 54% of the nodes were running on the old version of the Geth client. Since the new version of the software did not allow the old version of the software, the nodes that were running the old version of the software to access the main network, the miners themselves continued to contribute hash rate to the longest chain, which belonged to the nodes that had run the upgrade. So therefore, although there were less than 50% of nodes running with the new software, they maintained the support of most miners by always controlling the longest chain. Basically, they blocked the vulnerable nodes out of accessing the main chain until these nodes upgraded. So this resulted in the chain split not having major consequences for day-to-day transactions of most people. Now, while the news did not help Ethereum's price action this week, one of its competitors did seem to benefit, and that competitor is a project called Solana. So if we look at the Solana chart here, Solana was up 29.53% last week, and Solana has been gaining popularity as a potential Ethereum competitor for smart contract platforms. So again, interesting news here, and we're seeing essentially that the smart contract chain competition seems to be heating up. The other news that we covered, and we touched this on the headline, was the news that, or the headline that Visa made last week by jumping into the NFT scene and purchasing a crypto punk for $150,000. Now, strategically, this was a very interesting move as Visa garnered tremendous publicity and media attention simply by purchasing an asset. By doing so, it triggered a market rush into the asset itself and made the price of its own investment rise. Again, just for context, here's the headline that broke, basically showing that Visa bought a punk for $150,000 and immediately triggered an NFT market rush. From this perspective, this could be Visa's best performing marketing expense. And Visa is not the only one doing this. Here is another interesting headline that came out last week, which points out that NBA superstar Stephen Curry also bought an NFT last week, a Bored Ape. The choice is interesting as this seems to be an up-and-coming community within NFTs. So the trend for big brands to purchase and legitimize NFTs or NFT communities, it definitely seems to be heating up. And we should continue to see examples of this in the coming weeks until we reach NFT saturation. One last fascinating insight from the NFT market in the last few weeks is that the growth in market capitalization of stablecoins like USDC and others seems to have plateaued since August 10th. And we want to share this data point here. 1 second. So here is the market capitalization of stablecoins. 1 second. So as you can see, essentially, the market capitalization has been pretty much flat for all of August, peaking sometime in August 11th and not really elevating since, which again is quite interesting if you compare that to the last 3 months. Once this updates, we'll see the difference between essentially the 3-month trend and what we're seeing in the month of August, which is essentially that these tokens have been growing quite exponentially up until August, and on August, they essentially seem to have plateaued. So as you can see here, we were still going from essentially 22 billion in USDC all the way up to 26, and it was growing now 27, reached 28, and essentially it plateaued right here in August. So the connection here could be that as NFTs are getting closer to real-world artists and more mainstream participants, many of these will look to monetize back to the real world, exchanging USDC for dollars and therefore neutralizing the growth for a period of time. And moving over to our Bitcoin mining difficulty commentary, we see that hash rate continues to pour into the network. Last week's difficulty adjustment brought difficulty up by 13% to 17.62 terahashes. For context, that's where we were around July of last year. As you can see on your screen, the mempool continues to remain eerily quiet, even in light of price volatility. This is a great thing for on-chain transaction speed and cost. So again, conditions remain quite good if you want to be transacting on-chain right now. Now, as always, we leave you with what's ahead for the week. As we've covered here recently, there are growing market signals to point to a shift in composition of Bitcoin derivative collateral. What does this mean? Well, this sounds complicated. It means that investors are choosing to collateralize their Bitcoin trades or Bitcoin derivative trades with stablecoins rather than with Bitcoin. Where is this evident? A few places. For one, as we just saw in our mining difficulty section, there is less and less demand for on-chain block space. Fees have remained quite low despite market volatility. This is a huge signal. Naturally, large investors are incentivized to move Bitcoin quickly, and therefore they bid up on-chain fees to move collateral across exchanges in times of volatility. Lower fees means less competition for next block confirmations, so less demand for moving Bitcoin around in a fast manner. Second, we're seeing shallower dips in price. For context, it was a 70% drop in price from the top to the bottom in the 2017 to 18 rally. So far in the 2021 cycle, we've seen that Bitcoin found support after a 55% price drop. By the same token, price seems to be moving at a higher velocity to the upside, as stablecoin collateral has a buffering effect on the way down, but it accelerates short position liquidations on the way up. One last word on Bitcoin futures is that the big boys are gearing up to trade in the CME. Citigroup announced last week, or Citi announced last week, that is getting ready to start trading Bitcoin futures. As these groups enter, look for the implied yields on these futures curves to get squashed down even further. And a few words on the US regulatory landscape. It is looking less and less likely that the proposed crypto regulation in the United States will have any changes made to it. A deal in the White House last week eliminates the probabilities or the possibilities of any amendments to the infrastructure bill. And let's just put that headline in the back of the screen for a second. Now, while this is not a deal breaker, it is certainly a setback, as it is much easier to get laws amended before they pass than after the fact. All is not lost, however. As we've said here, the laws won't come into effect until 2023, and a lot can happen in 2 years. Now, as always, we wrap up with a summary of the upcoming economic data and earnings reports for the week. This week is a little bit quiet. We have just Canaan Inc., publicly traded Bitcoin mining manufacturer, reporting earnings today, Monday, and we also have a U.S. unemployment rate update on Friday. So if you learned something today, if you enjoyed the show, I welcome you to like it, subscribe to our channel, share it with your friends. If you don't yet have a Ledn account, I welcome you to check out Ledn.io and learn how you can start earning up to 6.1% in your first 2 Bitcoin and up to 2.25% on all balances after 2 Bitcoin, and up to 9% APY on all of your USDC no tiers starting as of September 1st. We also have the best rates in Bitcoin-backed loans if you need cash but don't want to sell your Bitcoin, and no-fee trades for moving between USDC and Bitcoin. So thank you, everybody. Have a wonderful week, and see you next time.